So our next speakers are going to talk about the TCJA of 2017, what the changes are that we're maybe expecting, and what it's going to bring if it does sunset. For that, we have Hunter Norton, who is a tax director, and Richard Oremus, who is a partner at Farkouh Furman Faccio, CPAs and advisors. They are our sponsors today of our CPE credits. They deal with high net worth clients, families, businesses, international tax. And with that, I give you Hunter and Richard.
Thanks, Lou. I'm Rich, and this is Hunter. We're going to concentrate on the income tax provisions of the TCJA today. I know some mention about estate tax, but we're going to concentrate on tax. And trust me, I understand that I'm standing between you and the weekend, so we'll try to make this as interesting and as quick as possible. So, when we first got assigned this task to speak with you today, we were thinking that, it's 2 weeks since the election. We're still not going to know who's going to win. It's going to be in the courts. But we know a lot now, right? Surprisingly. So the Republicans will control the government. And let me skip to the next slide. Well, stay at this slide. We know that this Tax Cuts and Jobs Act of 2017 was the major accomplishment of the Trump's first term. But some of the rules in the act expire or sunset. And one of the things in my mind when we were starting to do this was, well, why does it sunset? What's up with that? So just to give you this little background on that, so there's this thing in the Senate called the filibuster, and there's also this, if you want to escape the filibuster and escape debate on laws, there's something called budget reconciliation. So just to understand, and when you do budget reconciliation, you can only affect the debt by like 10 years. So that's why this sunsets, and they have to talk about it again. So a little background on that.
Okay, so with regard to, it's been brought up earlier today about the budgetary impact of the extension of the expiring provisions of the JCA, but just to go back over it, if they were to extend all the provisions that are about to expire, it would cost about $3.5 trillion over a 10-year period. So, I think one of the things that's happened over the last few years is that we've gone through COVID, and when this law was written, the Congressional Budget Office didn't anticipate COVID, and right now we're in a much different situation in terms of the amount of debt we have, the amount of deficit, our current deficit, and the extent to which the debt is going to be a percentage of our GDP is expected to go up substantially over the next 10 years. So notwithstanding that Republicans control the executive branch in both houses of Congress, it's not an automatic slam dunk that they're going to extend these provisions because the cost is going to be significant.
At some point in time, there's going to be a reckoning on the debt, and there's no guarantee that a lot of this will, and a lot of the other provisions that obviously Trump has put forward on Truth Social or in his rallies about not taxing Social Security and not taxing overtime and not taxing tips. So a lot to be done. So now we're going to talk about some of the provisions in the code that are going to expire if nothing's done after 2025. And the biggest one is marginal tax rates. What we'll try to do, like Hunter just said, I've heard $3.5 trillion, we've heard $4.5 trillion earlier, $4 trillion. So it's going to be an expensive proposition to extend a lot of these tax rates. This one being the most expensive. The cost of extending the marginal tax rates reduction that happened in 2017 is $1.8 trillion. So maybe half of the cost is all right here. So what was changed? Marginal tax rates decreased. Highest marginal tax rate was 39.6. Now it's 37. Still 7 tax brackets, but all those tax brackets either stayed the same or decreased the percentage, and also the amount of income in those brackets increased. So less income getting taxed at lower rates, which was a benefit to, I think, everyone. I don't think anyone's complaining about it.
So the TCJA changed the way in which most taxpayers calculate their tax on their return, such that standard deduction essentially doubled. However, they took away personal exemption, and then there was some enhancement to the child tax. The net of all this does not make a huge or did not make a huge difference to the average taxpayer. So in budgetary-wise, when we look at the costs, it really all nets out to itself. So if these provisions expire, we're going to lose the higher standard deduction, but you're going to gain back personal exemptions for each taxpayer in the family, be a benefit. But the big picture that you'll see is that more people will be having to itemize their deductions again because they'll be comparing their itemized deductions with lower standard deduction.
All right, so the doubling of the standard deduction simplified your taxes. Now you no longer would itemize because your standard deduction is already going to be $20-something thousand. And just to talk about the cost again, we'll try to reiterate that with each slide. So these three provisions are kind of net neutral as far as the budget goes. $1 trillion cost to the doubling of the standard, $1.6 trillion savings, eliminating the personal exemptions, but a $600 billion cost to doubling the child tax credit. That's really taking from one pocket and putting into another as far as these people. Another provision that's set to expire under TCJA after 25 is that your contributions to charities, the limitation is going to decrease from 60% to 50% of your AGI. Now, this isn't that big of a deal, but one of the things that we wanted to emphasize here is that if the standard deduction is reduced, people are going to be itemizing. And if you're itemizing more, maybe you're incentivized to give to charity a little bit. So maybe one person that's looking forward to, or people that are looking forward to the reduction in the expiration of these are charities.
Another provision that was a big change, but probably not known by the average person, that the ability to deduct personal casualty and theft loss was substantially reduced. So under the TCJA, you can only deduct casualty losses to the extent they're attributable to a federally declared disaster. And that was a big change from the prior law, which allowed you to deduct casualty losses from any unreimbursed casualty losses and theft losses, just to the extent they clear a hurdle, a 10% AGI hurdle. So, you know, we've had calls from taxpayers that have had involved with theft or victims of theft or some sort of scheme, or there's been a lot of property damage that's gone on in the last number of years here that is not necessarily a federally declared disaster. Well, however, for the time being, these items are not deductible.
A lot of the work of being a tax professional is don't shoot the messenger, right? You know, getting a call from a client or getting information from a client about how they lost all this money and they want to deduct it, and then saying, "Oh, sorry, that's no longer deductible." That's kind of one of these provisions, and there's others that we'll talk about.
So if it expires, they'll be coming back.
One thing One thing I didn't mention about these next couple of slides, these are all itemized deductions. And like I said, we wanted to talk about the budgetary costs of these. All these itemized deductions are a savings to the budget of $900 billion. So not a small amount, about a quarter of what the total cost of
when you sum them all together.
Yeah.
Some are favorable or unfavorable. The net
Correct.
is the net savings to the government.
So another rule that's set to expire is a rule about mortgage interest deduction. Prior to TCJA, your mortgage interest deduction was limited to interest on $1 million of principal. And you were also allowed to deduct interest on $100,000 of home equity. After TCJA, that limitation was dropped down to $750,000 principal, and you no longer get a deduction on your on home equity loan. So I know though one thing that is important here is that $750,000 limit is on debt incurred after December 15th of 2017. So a lot of clients would call us and maybe refinance their, talk about that, Hunter.
Right. No, just to be clear, so if you have clients that incurred original acquisition debt prior to the end of 2017, refinancing of that acquisition debt subsequent to 2017, $1 million is still considered. You can deduct the interest on $1 million of that. One a provision that most people are very familiar with is the limitation under the TCJA on the deductibility of state and local income property taxes. That, of course, generally speaking, is limited to $10,000. We would note that there are high tax states, for knowing that their constituents would be very upset about this, put into play sort of a vehicle to at least provide some relief to business owners who operate business through a pass-through entity. You have to have an entity, and it has to be a business interest. It doesn't help, say, a wage earner anyway. But if you do, regimes are put into place whereby you could effectively pay your state income tax as an entity-level tax to the state, and that would qualify as being tax deductible for federal tax purposes, and you get credit against your individual state tax return. And those are called the PTET taxes, PTET tax rule.
Workarounds that done by the state, which benefit a lot of people.
Yes, it's very beneficial, and it includes even investment income. It doesn't have to be an operating business. The other thing we'd like to note is that when Congress revised the rules to limit the deductibility of state and local taxes, did not at the same time revise a separate set of rules that provide for deductibility of real estate taxes and interest for shareholders of co-op interest. They didn't revise those rules. So we would just like to note that if you're a shareholder of a co-op interest, you have a client who is, may consider taking the full amount of your real estate taxes as an itemized deduction. Those taxes are deductible under Section 216, separate section for the general limitation on taxes.
And we're going to touch base in a couple of later slides about the alternative minimum tax effect of a lot. Another provision from TCJA that's set to expire in 25 or after 25 is deduction for miscellaneous. Prior to TCJA, you're allowed a deduction in excess of 2% of your AGI for safe deposit box fees, investment advisory fees, tax preparation fees, unreimbursed job expenses, employee. After TCJA, those expenses were going back to the don't shoot the messenger theme. A lot of clients called during COVID. I have to work at home. I'm an employee. I just built out my new office. I just bought these printers. Here's all the receipts. Please deduct these. Oh, sorry. No longer a deduction, but something that will come back after if this is higher. And we'll also highlight this again too. Similar to state and local taxes, miscellaneous itemized deductions are not a deduction for alternative minimum tax.
So the TCJA implemented, as a budget gimmick, for lack of a better term, a temporary limitation on the ability to deduct business loss. Or actually, sorry, wrong slide. Sorry. The TCJA, prior law limited, once your AGI got over a certain threshold, limited the ability to take certain deductions as itemized deduction. It was, so your miscellaneous, your itemized deductions were phased out once your AGI got over $320,000. And that reduction is capped. It could go all the way down, you could use up to 80% of your itemized deductions knocked out. However, this limitation under prior law did not apply to quite a few things, as are listed here: investment interest, charitable contributions, casualty and theft, medical. So basically it was going against your state and local taxes, miscellaneous itemized deductions, carved back by law. So under the TCJA, those limitations don't apply.
Another expense that was limited or eliminated for TCJA, moving expenses and moving reimbursements. So prior to TCJA, qualified moving reimbursements were excludable from taxable income. Also, you get a deduction for moving expenses. Post TCJA, no longer. The only armed forces members were exempt from picking up the expenses, but everyone else longer. Again, messenger, deduct that. Tax advisor says no longer under TCJA, but possibly sunsetting.
Okay, so one of the key concepts that we all have to keep in mind is the alternative minimum tax. And this has been sort of low-key over the last 7 years because really the number of people who have fallen into the tax has dramatically gone down to really a very small fraction. But prior to the enactment of the TCJA, the growing number of people in the millions were subject to the alternative tax, and that was mainly due to the fact that the exemption was not indexed for inflation. So unfortunately, the alternative minimum tax, it's a separate tax regime, and you calculate tax on a separate basis. And certain items, generally speaking, that are deductible for regular tax are not deductible for alternative minimum tax, and you're allowed to take an exemption against it in determining what your minimum taxable income is, and multiply that income by tax rate, generally 28%, and compare that to your regular tax liability, and the difference, the alternative minimum tax.
And to keep the theme about the budgetary costs of these provisions, this is a really expensive one. $1 trillion cost to extending vision. Talking about $4 trillion total, $1 trillion of it is right.
I mean, just to emphasize why, I mean, because it was a way in which Congress used to gather up a lot of income, sort of through the back door. You talk about the state and local tax deduction, how important they are, but for a lot of middle income people or people that are in high state and local states, they were paying quite a bit of, they weren't getting the full benefit of those deductions. So Congress, they were intentionally not increasing exemption on this. But with the TCJA, as we'll see, the exemption went up a little bit, and then the point at which you phase out of that exemption went up dramatically. You just move.
Yeah, so some important distinctions between the regular tax and the AMT. State and local taxes, not deductible for miscellaneous itemized deduction, deductible, regular, not deductible for AMT. And then also, AMT has a different exemption amount than your regular tax does, with different phase-out periods. So the thing I want to highlight here is what I just said about the exemption, right? You'll notice that your current exemption in 2024 is $133,000 for a married couple. And you start to lose that exemption, meaning exemption means you don't get taxed on $133,000 at 20 years. And you start to lose that when you're over $1,156,000. Good amount of money. Prior to TCJA, the change in the, it's a little odd to look at here because in 24 your exemption is 133, but back in 2018 it was 86. Inflation changed that, so that's pretty much the same number. But what you see the big change here is that your phase out started pre-TCJA at $164,000. Now it's $1,150,000. Big change, right? So everyone up to $1,156,000 is getting that $133,000 exemption tax and not paying tax on that piece. Prior to that, pretty much everyone was. That's really the big change here, and one of the things that they don't extend it and continue to not really being involved a lot with the AMT planning, but something we were involved with a lot prior to that. This next slide kind of touches on that.
Yeah, I mean, that was, as Rich was noting, prior to the TCJA, one of the questions is how can we maximize our clients' tax deduction? So you look at year end, could the client pay more state income tax? Could they prepay real estate tax? And at which point is there no return for that? And that point is the point at which when you estimate what the alternative minimum tax is, when you start to pay alternative minimum tax, there's no benefit of paying additional real estate taxes or state income taxes in the current year. But because so few people have fallen into the AMT, we haven't had to do as much of that work, but that December work may be coming back to us.
Yeah, I see a lot of tax accountants out there, so if this does expire, we're gonna have a lot more work to do, more years, and don't plan those December vacations in. A big provision of TCJA that is set to expire also is the 199A deduction, the deduction for pass-through business income. Generally, this is provided that income from a pass-through, either a single member LLC, sole proprietorship, partnership, S corporation, income from those entities, business income from those entities, get a 20% deduction. I make $100,000 on my Schedule C or as a sole proprietor, I get a $20,000 deduction off. In general, that's what that was. But there were some certain limitations as your income grew. In 2024, if you're a married person over $384,000 of income, you're gonna have to start dealing with those limitations. Limitations. You're limited on your deduction, 50% of the wages you pay employees. Don't pay wages and you make more than that, you don't get a deduction. Or you can do 25% of the wages you pay and 2.5% of the property you have. You don't have any property, you don't have any wages, you're not getting the deduction over. Also, another big limitation that a lot of the accountants out there and a lot of the lawyers out there, a lot of the investment professionals, medical professionals don't like too much is something called the specified service trader business. I'm not going to get into exactly what makes that up, but so accountants, lawyers, doctors, investment professionals, you're in this specified service trader business, you're an SSTB, don't get a deduction any longer. So, but this is one of those items that is set to expire after 25, unless it's extended. Now, one of the interplays and one of the reasons that this was put into the provision was that the corporate tax rate was reduced down to 21%. So in thinking of that, I believe Congress said, well, if we're going to reduce the corporate tax rate, we should reduce the tax rate on other business income that's not in corporate form. Now, the 21% corporate tax rate is not set to expire. It will continue. So it would be odd, right, Hunter, if they didn't do something about this, and it would really alter the way that we're deciding how to create entities, right? Should I form as a corporation? Should I form as a
Yeah, historically, small businesses have operated, at least in recent years, under the pass-through concept, and whether it be an S corporation or a LLC/partnership, and this would, provide a skew the incentive towards C corporations. So Congress can be under a lot of pressure to keep this one going, but it will not be inexpensive.
And again, to touch on the budgetary part, $500 billion to extend this. 15 to 20% of the total cost is.
One of the welcome provisions of the TCJA for business owners is the expensing provision, whereby between 2018 and 2022, business owners who placed in service, assets that expected life longer than a year would be able to fully deduct the cost of those assets. The general rule prior to the TCJA, although there were some exceptions over time intermittently, is that when you place an asset in service, you have to recover the cost of that asset over its useful life or the life that's prescribed in the Internal Revenue Code. So this expensing provision is in a phase-out period now, so between 2023 and the end of 2025, it decreases 20% per year. So in 2024, you can only deduct 6% as an immediate expense, then you depreciate the remaining cost of your asset. So this definitely was a popular one. One provision, just to note, that exists in the code that's irrespective of TCJA is Section 179, which allows small businesses that don't put an inordinate amount of assets in service potentially expense up to $1 million. However, there's a big catch that comes with it. You need to take a current deduction, you need to have some sort of trade or business income. So if you're running losses and you don't otherwise have trade or business income, that deduction is just going to spend it and carry it forward. And you won't be able to offset your investment income or wages or other things like that. but that the provision is out there.
I think this does affect a lot of small businesses. Small business owners will manage their business on cash, right? They spend money, they want to deduct that payment. A lot of times it's hard to tell them, well, no, I'm sorry, that's going to be deducted over years or 7 years or 5 years. So it's really nice that this provision, I think, really stimulates growth as far as small business owners making it that they get. Another provision in the TCJA that is set to expire after actually this one's going to go through 28, is the limitation on business losses. So starting in 2018, we're limited, and actually in 24, you're limited to a deduction for all your business losses, businesses from losses from all your business and income from all your businesses, net them all together. And if it's a loss, you're limited to $610,000 loss. You get to carry forward any excess. The carry forward is as an NOL, or net operating loss, not as a business loss. Kind of an interesting way this works is that in the first year of that loss, if I lose $2 million net, I get a $610,000 deduction, and I carry forward $1.4 million to the next year. And the next year, it's an NOL. It's not subject to the same limitation as it was when it was incurred. Kind of an interesting little thing.
Yeah, so it's not tremendously punitive. It's just some sort of budget technique to time value of money to sort of slow down the level of deductions, but it's not a huge impediment. You really just delayed a year for the moment. So what are in light of all these potential expiration, what are the planning considerations? Really few main points to take away. Tax liability will increase. More taxpayers will itemize deductions, both because, as we discussed, the standard deduction will be going down, and we'll have larger amounts of deductible expenses. We'll be able to fully deduct, at least for regular tax, not necessarily for AMT, state and local taxes and real estate taxes, and we'll be able to take miscellaneous itemized deductions. So the takeaway is that we head into 2025, we want to have a chance. We want to try to accelerate income into 2025. If it looks like these provisions are going to expire, and we want to defer deductions into 2026, when we may be able to get a better benefit, both from a tax rate perspective and from items that will actually be deductible.
To highlight those two of the points about accelerating income, deferring deductions in 25, we gave you two examples, and the first one is about property taxes. So it's 2025, I make $2 million. I have to pay my property tax bill, $75,000. I can pay it in December, or I can pay it in January. If I pay it in December, under TCJA, I'm not getting a deduction. TCJA expires, now it's January of 26, and I pay that $75,000, I get the deduction. Very simple planning technique, but something that you should be looking at the end of 25 to see where TCJA
and there may be a real benefit. It sort of depends. We talked about AMT. It sort of depends on the taxpayer. So while many of us would be an AMT, we do have taxpayers that have a very heavy skew towards ordinary income. When their marginal tax rates are north of 30%, and they can get their effective tax rate gets up there because they have so much ordinary income, they're actually not an AMT. So they would get a benefit for federal tax purposes for this real estate deduction.
And then similarly, you have a taxpayer, wage earner, woohoo, they're going to get a bonus, and they can talk to their employer. Maybe say, I'd like to enhance that or take that bonus earlier because I know I'm going to pay less tax on it now because of the tax rate. And we talked about 37 versus 39.6. So you give it to me on December 31st, I pay 37%. You give it to me on January 1st, and TCJA is not extended, I'm paying 39. I know it's 2.6%.
Well, it's not only that, it's also some of the brackets below. You would still get some additional tax savings. Next one.
So now we're going to switch lanes a little bit, get away from TCJA, and try to talk about some other planning ideas that we specifically investment interest. You're allowed a deduction for interest you pay on investment debts. Hunter will talk about that in the next slide a little bit more. None of this was changed by TCJA. You're still allowed that deduction. Your investment interest expense deduction is limited to your net investment income. Your net investment income is excess of your gross investment income over your investment expenses. So what is investment income? Interest, non-qualified dividends, royalties, short-term capital gains, but not long-term capital gains and not qualified dividends. Those are taxed at a different tax rate, the capital gains tax rate. Those are not included in net investment income. But there is an option to make an election to have those included. We're going to talk about that in a later slide. Another important point is that you don't lose these deductions. If there is a limitation, they are carried forward.
So what constitutes investment interest? Well, essentially, the rules under interest is trace the proceeds from the borrowing to how the proceeds are deployed. So in this case, if no matter what you use as collateral, if the proceeds that you receive are traced to clearly an investment asset such as securities, could be something else that's investment in nature, interest associated with that borrowing will be interest expense. So other types of classic investment interest, the same way would be margin interest, obviously paid to a brokerage firm. And then one other type of cost that some taxpayers have a lot of and that you should keep an eye out for is if they are selling short, and in connection with the short sales, they have to pay short dividends. Those are the dividends that they're paying to the owner that they borrowed the security from. As long as that short position is open for more than 45 days, those short dividends qualify as margin, as investment interest.
The one thing that we've seen over the last couple of years with several clients are using assets, not necessarily investment related, to create this investment interest, tracing, using proceeds from debt to invest. That thus is making it investment interest or investment debt, regardless of what the asset that's secured. So one idea is to use a home or real estate as the leverage or as the collateral to take on debt. Why is this better than, say, a margin loan that I can secure? Well, might get beneficial terms on the mortgage, carried out longer usually, no margin calls, get a fixed rate. Back in 3 years ago, get a nice 30-year fixed rate mortgage for 2% or 3%, and now you're looking at making investment returns on that north of Treasury now is what, 4.5 or 5. So that was a good deal that years ago. So one idea here that we've seen clients take it.
Yeah, they're essentially paying their property with, these are clients that can pay for a property with cash or may already own house outright, and they go ahead and they refinance that house, use those proceeds to invest in the market and reap the advantages of mortgage debt versus.
Yeah, it's important to note the tracing, that word like tracing. So you're going to take in the proceeds, financing, and invest in portfolio of bonds or stocks. Actually show that. I know money's fungible, but you can actually show it.
So we want to give you an example of sort of one of the techniques of using investment interest expense as a way to shelter gains. In this case, we have a taxpayer who is an art collector as an investor. This is an investment property, and in addition, he has some other, sort of typical things an investor might have. He's got some qualified dividend income. He's got some interest income. He's always in a relatively high tax rate. And if if you just did the default calculation, you didn't do anything further, and he has, he has also, I mentioned, a substantial investment interest expense, which could have arisen from, a combination of margin interest and, short dividends. It could easily get up to these numbers, and this is carried over a period of years. You can carry this stuff over, indefinitely, so it can build up over the year. So if you just do a default calculation and you only look, okay, what is the investment interest on his tax return, well, the investment income, in this simplified case, he just has investment income, interest income of $30,000. So the amount of deduction that he could take from the investment interest expense deduction would be about $30,000. We're assuming no investment interest expenses. So that's a sheltering of $30,000, and that would sort of happen automatically. But what if he makes the election to characterize capital gain income and qualified dividend income as investment income? Well, you can make that election. You make it right on the form. It's under Section 164. And that would allow him to increase his investment income by the amount of the $300,000 gain on the art held for investment, not for personal use, plus the $50,000 of qualified dividends. So you're sheltering, just on the art alone, over $70,000 of tax. You'd be using another $350,000 in investment interest expense. Of course, there is a trade-off, Rich.
Right. Yeah, there is an opportunity cost to this. It's not an automatic. So in Hunter's example, he would save by electing to tax the $300,000 and the $50,000 at ordinary rates. He would be saving the original tax on that, which at the max is a 20. Yeah, it's a 20% capital gains tax rate and a 3.8% net investment income tax rate. So he's saving 23.8% tax by making. That's great. Except what happens next year when he gets $1 million of interest income from someone, right?
Or short-term capital gains.
Or short-term capital gains. Something that's going to be investment income is going to be taxed at 37% or 39.6% at the highest rates. Well, I think at that point, he'd really much rather have that $350,000 that he used the prior year, later year. So you do have to look at it that way of, what's the possibility of what is that opportunity cost of us making this election currently instead of letting it carry forward for possibly, higher income and getting more benefit.
Yeah, and also the magnitude of the amount of investment interest expenses generating. So if he's always going to have surplus, then, it's not as difficult of a call.
One other thing to think about over the next couple of years with the Republicans controlling government is back in 22, Inflation Reduction Act was put into place $80 billion for the IRS to modernize and to increase enforcement. Over the last couple of years, though, with some horse trading and trying to pass some other laws, the Republicans have been able to knock some of this budget down. So something to think about as we move forward, with the Republicans controlling Congress and government is that, the IRS might be in trouble. It might be a lot harder to call them again, because I have noticed over the last couple of years, it's been a little bit easier. But, looking forward, look for the Republicans to try to eat away from this.
Yeah, it comes up in these appropriations, these annual appropriations bills, and they try to put a provision where it automatically would kick in a $20 billion reduction. But even if it's not automatic, I think there probably will be an attempt to assert that and carve it back. So it remains to be seen. They have the majority. So,
and our last slide, just again back to the IRS and partnership audits, something we've seen a bit more of.
Yeah, just real quickly, something us as practitioners see may not be as taxpayers may not be as aware, but in 2015 they passed a law which came into play in 2018, changing the rules as how the IRS can audit partnerships. And the reason why they did that is because it took a lot of effort for the IRS to ultimately collect money from the partners when they made a change to the taxable income of a partnership. So under the new rules, the IRS can assess a tax directly to the partnership, or at the partnership's election, it can force the partnership to send out the adjustments to the partners, and then it's up to the partners to calculate what the additional tax will be, and then they may get a penalty directly sent to them from the IRS, and it just allows the IRS to audit many more partnerships. So we're seeing more of these notices coming through. That's it.
Any questions? Yep.
Yes.
$1.4 million, yeah.
Yeah.
So
No,
in
no,
the
that's
following, you're good. Okay.
No, I'm sorry. Yeah, the 610 is on the loss that you incur in the current year. So there's no limit. So when you have that 1.4 million of carryover of NOL, that's not limited other than the rules that pertain to NOLs, which only allow you to deduct up to 80% of your tax.
Yeah, because it'll go under the NOL rules at that point.
Any other questions? I'd like to bring our other speakers back up. Race, you want to come back up? Yeah. Round of applause. Thank you, gentlemen. Appreciate it.
Thank you, Lou.
So we can open up for questions to any of our speakers on any topic. I just want to kind of talk about one asset class, and Ray mentioned it, and that is retirement accounts. So when we have clients walk through our door now, the vast majority have significant retirement accounts. You guys can sit down or stand up or however you want to do this. But now we have the final regulations, and Ray talked about those. How do we name beneficiaries? And what other things should we be thinking about and looking at for our clients with regard to retirement accounts? The current tax rates are lower. Roth conversions is something that a lot of people are looking at and actually executing on right now. Anybody see a lot of Roth activity in the conversion area, those financial advisors out there? So from an income tax perspective, how does the TCJA extension impact us? And does it call for more Roths, or should we be kind of sitting back and taking our foot off the gas pedal at this point?
Well, I think it goes to the whole point of,
We have handhelds, I think.
accelerating income. If it at the provision higher the tax rate, it would behoove one to consider.
And Ray, just talk a little bit about the new regulations, the stretch rules, and how a Roth impacts not only the current account holder, but the beneficiary as well.
Well, a couple of things is the Roth IRA, I think, is ignored for required minimum distribution purposes. So you take that out, and whatever and then you use the regular retirement account to calculate your required minimum distribution, and only funds withdrawn from that will satisfy your required minimum distribution. So I think we're seeing a lot of Roth conversions, and I think maybe if there is no sunset and the rates continue to be lower, that might continue to happen. That's my opinion.
Yeah, but in terms of the beneficiary rules, the 10-year rule, the Secure Act, the Roths are still subject to 10 years.
Yes, they're subject to 10 years, but they're not subject to annual distributions because they weren't taken out beforehand. The rule is it has to come out at least as rapidly as it was coming out right before the owner died. And if you have a Roth IRA, there's no lifetime requirement of taking money out. So at the end of the day, yes, the 10-year rule applies, but typically no annual distributions have to happen in years 1 through 9.
So that gives a pretty good investment opportunity for the beneficiaries.
No question.
For that 10-year term period, that's tax-free growth.
Yes, it is. And you might as well just leave it in there and let it grow on a tax-deferred, tax-free basis. Basically.
Absolutely, yeah. So a lot of times clients come in and they say, well, I've done the math, and they might be an engineer and they might have their own spreadsheet. I've done the calculations, and it doesn't pay for me to do the Roth conversion. But I think a lot of people leave out that 10-year tack-on period of tax-free growth for the beneficiary and the economic impact that it has for the beneficiary. Over 10 years, to double the assets, it's entirely tax-free growth. So when we're planning, we look at that and work with our clients and their financial advisors to look at the Roth conversion. Life insurance is another option. If people are young enough and insurable, they could start early withdrawals prior to age 73.
No question about it. I think these regulations, for the most part, they confirm the whole annual distribution thing for a 10-year rule once the owner dies after the required beginning date. But I also think that gives us a little bit more options in terms of the owners and the beneficiaries as well, and a little bit more flexibility. So, and again, these were just published in July, so we're all trying to work it out. But
yeah, there's a commentator, Natalie Choate, who's made a career and wrote a book, and everyone kind of follows her as the pundit in this. And we have her book online, and we refer to it frequently and attend her seminars. So it's such a complicated area, especially naming trusts as beneficiaries. And we've had this conversation. Naming a trust for the spouse is not as easy as it may seem.
Well, it has to be a conduit trust, number one, which means what comes in has to go out. A Q-tip typically will be that, okay? And if you set up a Q-tip where the Q-tip is the beneficiary of the IRA, the spouse gets all the income, and let's say daughter is named as the remainder. You can spread out distributions over that spouse's life expectancy because it's a conduit trust.
Right. A lot of times in second marriage situations, they want to have the ability to leave the retirement account to the surviving spouse, but they don't necessarily want a conduit trust where it's all going to pour out and they're going to lose the value for their own children who it's going to ping back to when that spouse dies.
Right. So, well, another option is you name the spouse outright as the beneficiary, receives distributions during lifetime, and the remainder beneficiary is kids from prior marriage. Now, I'm not even using a trust, but I am prolonging distributions during life expectancy.
Right. So one other issue I wanted to throw back, you talked about the charitable contribution limitation, 50%. Yes.
Required minimum distributions. An inherited Roth.
Inherited
does.
IRA.
An inherited Roth that's inherited pre-2020, they have to take required minimum distributions.
They don't get to keep it forever, in other words? Yeah.
Right.
Yes.
So, but if the original owner dies after 2020, then there's no required minimum distributions on a Roth. It's just a 10-year
Yes,
payout.
and the reason has to do with at least as rapidly. The owner does not have to take out lifetime distributions of a Roth IRA. We're talking about after 2020.
Right.
So once that happens, the 10-year rule applies, but no annual distributions are required because the owner was not taking out annual distribution.
Okay, thank you.
And I want to ask one of our CPAs who wants to take this question, the 50% to 60% contribution limitation, contrast that with the ability at age 70 and a half to contribute $105,000 directly from an IRA to a charity. Which one wants it?
There is there is a rule you can give directly outside of an IRA to a qualified. It is changing to $105,000. And why this benefit reduces your AGI, so you possibly get. I see it's really big savings in New York State, right? Because now you're also limiting taxability. Maybe wouldn't get a charitable. A lot of times people would say, well, I'm getting a charitable deduction or I'm picking up the income, it's the same thing, and that's zero. But in New York State, you might not be itemizing, or you might not tax qualified. That's where.
So a lot of planning around IRAs, 401ks, retirement accounts, a lot of activity and a lot of reason to plan around them because that accumulation, the government's not stupid. They know that the money's sitting there waiting to be taxed. That's why they passed the Secure Act. And that is to push the money out over that 10-year time period and collect the taxes. And they're counting on that tax revenue. One of the other techniques that we use is a charitable remainder trust as a beneficiary of an IRA. So you can stretch it out over 20 years instead of 10 and get a little bit better treatment if you have some philanthropic intent as well. So IRA planning, a big piece of it. Life insurance sometimes folds into that, but something that we should all be thinking about for our clients as we look at what do their portfolios look like coming in. Some people have large marketable security portfolios, but others, it's a home, maybe two homes, and very large 401k. That's where they put their retirement savings like they were supposed to, but now you've got that ticking time bomb. So planning is important for those. Other questions, any other areas that we've covered, anything that you'd like to have covered by the panel? Yes.
Effective inherited trust?
Yes.
Can you explain that how it works again?
Sure. The Beat It, as we call it, is a trust created for the benefit of the individual who has the wealth. So a business owner, for example, would have a parent, their father or mother puts $5,000 in a trust for them and says, that's your trust, I've created it for you, but I'm going to give you a right to demand that $5,000, like a crummy right, demand right. And by creating that demand right over the $5,000, under 678 of the Internal Revenue Code, it makes the entire trust a grantor trust. So by having a grantor trust for the beneficiary, that allows the business owner to sell their business to the trust, and they take back a promissory note. We get discounts based upon the valuations that we talked about, different minority interests, marketability, and we have the ability to put that business in where it's going to grow. The note is static at a fixed interest rate based upon AFR, and we can use that note over time because the business is building value inside the trust. If we need to fund the lifestyle of the business owner, we can make principal payments on the note, and because it's a grantor trust, there's no taxation on the interest payments. So it's a tax-free transaction going in, no acceleration of gain, and a tax-free transaction when they receive interest on the note that's in their name.
So you have a debt and a debtor here?
Sorry?
A debt and a debtor here?
A debtor?
Yeah. Are you having created
The trust is the debtor.
So who is the one that, I mean, the trust, you have the beneficiary is the children, right?
The beneficiary is the business owner. That's the point. They can be their own trustee, and they can be the beneficiary of that trust.
So who control them? Who control this
The
person?
business owner controls the trust as the trustee.
But then he has power.
But it's a third-party trust. That's the key. The business owner didn't create the trust for him or herself.
Who created again?
Mom. Mom put $5,000 in a trust for son. Son owns the business. Son sells his business into that trust. Because they're not retained powers. There's not a retained right to income. There's not a retained right to change beneficiaries. Mom created the trust. So we can have a limited power of appointment. We can have discretionary income and principal for health, education, maintenance, and support. So that's a standard. We also have an independent trustee. If we happen to venue it in Delaware, we have an independent trustee that can distribute to the business owner for any purpose.
So let's say it's Delaware Trust, are they going to be the co-trustee?
They're going to be the administrative trustee. Remember, it's a
The
fully
distribution.
directed trust.
The distribution part? No.
They can have distribution powers.
Right.
Yes.
So
So if health, education, maintenance, and support isn't enough, and they want to take a trip around the world, they can go to the independent trustee. Could be a Delaware trustee, could be any independent party, and ask for the $100,000, $200,000 to take their trip. Even though it's not part of their standard of living, they can still get money through an independent trustee.
So the son, as what your example is,
Yeah.
that person able to have control of the operation and
Yes.
distribution?
Yes.
Wow.
That's too good to be true. That's why the slide said it. And the growth is outside the estate. Only the notes left. Okay. We'll take one or two more.
Going back to that same. So you had said it was a grantor trust
Yes.
of that parent that put that $5,000.
For the child. It's a grantor trust as to the son in that example. For income tax purposes, the creator of the trust is mom. But for income tax purposes under IRC 678, the grantor trust section 671 to 679, this particular one creates that third-party grantor trust status by giving that demand power. So that's the trick, is to get the demand power over just the $5,000 The entire trust is wholly grantor from that point forward.
And only needs to be done that once.
Yes.
Okay.
On creation. Mom's role, once she creates the trust and she gifts $5,000 to Sonny, mom's done. And then it's the son who's the trustee and the beneficiary.
So I have also a trust question. I heard there's a trust called Delaware Complete Non-Grantor Trust. So the purpose of that is to save not federal, but the state capital gain tax. Can you briefly explain how that works?
It's a DING trust, a Delaware Income Non-Grantor Trust. So New York has prohibited a transaction where you create that trust for the purpose of avoiding New York State capital gains tax. That would be in an incomplete gift. If it's a completed gift situation, so if you create a trust for the benefit of your children and it's a completed gift and you retain no other rights to it, then the gain is still then just Delaware gain and you have no income tax or capital gains tax in Delaware. So for certain types of trusts, it's still possible. But for what it used to be done, you have a $100 million business with no basis. So you're going to sell a $100 million business and you don't want any state capital gains tax. And one thing that everybody should be clear on, New York does not distinguish between income tax and capital gains tax. It's the same rates. So you go up to 10.3% for high net worth individuals, high income individuals in New York State, and that's capital gain. So they tried to do this so you could make an incomplete gift to that trust by retaining certain powers and have it be a non-grantor trust for income tax purposes. So you could put $100 million in, you haven't gifted anything, you don't know gift tax, and you could sell it without any state capital gains tax. That went away. They prohibited that several years ago.
They buy those some stocks, and if they have the gain, right, they gotta pay the tax. But if they create this kind of trust, is that some kind of tax planning?
As long as they don't have any more interest in the trust, yeah.
Okay.
If you're gifting, the gifted trust can invest and pay taxes, either trust or beneficiary rates. Remember, trusts, once they're non-grantor, are typically complex trusts. When you have a complex trust, the trust becomes the taxpayer. I think the rate about $15,500, where the trust hits maximum 37%. And then, so you're paying significant income tax on trust income, so you need to distribute the income out of the trust to get it to the beneficiaries. But a lot of clients use what's called a sprinkle trust. So you can create that trust in Delaware, and you can have multiple beneficiaries and choose what beneficiaries are going to receive income based upon their income tax bracket. So you can actually bracket shop the beneficiaries, sprinkle the income to them, the trust gets a deduction, and the income then goes on the beneficiary's income tax return.
Okay, so the bad thing about this trust is that this will reduce your lifetime gift exemption.
Yes, if you're going to do it as a completed gift, yes.
Okay. Thank you.
Other questions?
The other thing we're seeing is if you make a completed gift to a Delaware trust funded with marketable securities, all right, and there's no New York source property, yes, you can avoid New York income tax, but New York has the throwback tax, which we see a lot. And you have to plan around. Throwback tax means 3 years later, you make a distribution to a New York resident, it could be subject to New York tax, even though it wasn't when the event happened. So we see a lot of that. I don't know if you guys see that.
All right, with that, I think we are all ready for the weekend. Thank you all for your time and attention today. Thanks for coming. Don't forget to fill out your surveys, turn them in on the way out, and we will hope to be back here in a warmer room for the 20th annual Intergen.
We get invited next year. See you next year. All right.
attorney, they'll take it. So I think that's probably, I have to go back to my office anyway. I'll be down.